Okay. All right. Good to be back. The title of our presentation, Live Market Exercise. Essentially, we highlight the same tactics, the same method that we use in our own live market analysis, which we do a couple times. All right, GY, how are you? No, I didn't get to do any fishing. We fed the fish, though. There was this beautiful pond, and there's no fishing allowed, and they let you throw pellets to the fish. Just massive trout in there, rainbow trout. So that was pretty cool. That was my highlight. No, I didn't get around to do any fishing, though, but it was just gorgeous out there in the Rocky Mountains, Colorado. We stayed in Breckenridge. Thank you very much for asking. It's always great to get away. Live market exercise. My name is Jay Norris. As always, we need to point out that trading is a risky endeavor and not suitable for all investors. Hi, Carlos. Good to be back, sir. Good to see you. And some of the techniques I demonstrate are proprietary and should not be retaught or retransmitted in any way. My name is Jay Norris. I'm a 20-year trading floor veteran of the Chicago Board of Trade, which is to say I survived down there for 20 years. Pretty cool environment to learn about yourself. Not a whole lot you can take away from it as far as screen trading, other than the psychology of it, which is a big enough deal, I suppose. But from a methodology standpoint, that may as well have been 100 years ago. I've written a couple of books on trading which were published by McGraw-Hill and serve as the textbooks for our courses. There's the first one and there's the second one. One of the tactics we're going to show you today is highlighted in that second book on the right, Mastering Trade Selection and Management. Right there. What makes these books unique is that they both include trading plans which allow you to go back and back test the information provided. We believe that's pretty important for us. Transparency overall is important for all of us, not just me, but for yourself too. It's absolutely imperative that you have a good idea as you can what your winning percentage is for the method you use. What's the risk reward on that, all that good statistical information. How many of you guys overall have trading plans? How many of you guys have written out your trading plan and you keep that beat up piece of paper right next to you when you're trading? Come on, don't be shy. Show of hands. Who's got the trading plan? Because from our perspective, that's essential. I even pull mine out. I actually sent my current trading plan to our clients today. We sent that out so everyone's got that in their inbox. And I pulled it up several times today in referencing that. Borat, you got to get one. A couple simple rules, that can go a long way in there. And we'll get to that another time. But it's essential that you do have a trading plan. Yeah, Carlos, how can you trade without it? Absolutely. I need to keep mine out all the time. There's constantly reminders on them. Borat, good man. At least it's in your head, Borat. I right at the beginning would turn out not following it all the way. I tell you what, I love my trading plan almost as much as my wife. It's amazing the amount of experience that has been accumulated in that plan. I mean, I don't even hesitate now. I mean, I'm a much better trader than I was a year ago. Worlds better than I was 5 years ago. And it's because of that plan. I look at that plan and it's amazing the amount of experience that's in it. I mean, just today, in my plan, not to get off track, but correlations play a role in my plan. And essentially, when the markets are correlated, when they're moving together, I'm going to hold the trade longer. So I'm going to manage my trade a little bit different if markets are correlated. If the markets are not correlated, such as they have been for the last month, they have not been correlated. In low volume markets, the correlations go out the window. That's very important for us. If you're a mean reversion trader, that'll kill you. But when the markets are not correlated, that means you have a counter trend mindset. We actually highlighted a buy signal in the euro and it's very, very short-term charts. but we knew the markets were not correlated, so we knew we had to come out of that trade in a hurry. So when it got to that target, you wouldn't want to hesitate. But yeah, and having the trading plan ahead of me kept me so much more calm and focused than not. So you got to have a trading plan. And that's what's cool about our books. We put the trading plans right up front in the books. I did not know this. I always looked, to see how the books were selling on the U.S. Amazon site. When you go to the Canadian Amazon site and the European ones, the books do better there. So I don't know if it's Americans don't read as much, but at any rate, let's get on with it. I'm the founder of Trading University here in the Chicago area, where I spend a considerable amount of time teaching and demonstrating the art of discretionary trading in live markets. The methods we teach are both mechanical and behavioral, and we'll get to a little bit of that today. Before we go any further, though, I'm big on methodology. Before I can show you how to help with your trade selection, a few words on methodology. The first thing you need if you expect to trade successfully is have a robust trading method which works in all environments. It has to work in the dog days of August when the volume is low. It has to work when things are cooking in late September. It has to work, after the election. It's got to work in the winter. It's got to work in the spring. Counter trend. You have to have a method for all seasons. It took me nearly 4 years to put together a trading course that teaches an objective empirical method that the key here you can use in all trading environments. That's key. You really need to be able to identify the type of market environment you're in, so that if you're in a lower risk environment or not. It's all about environment for me. Markets are they're either growing or they're contracting. They're either going up or they're going down, and the biggest component of why they do that happens to be the economic environment they are in. Boy, yes, it is, because it's the same signals. Borat's asking a great question. He's saying, are you saying that your system works in both trending and range? The method, not a system. Yes, it is. It is possible, because while my triggers are the same, the management is going to be different. You're always going to know exactly what type of environment you're in based on the time frames, how the different time frames are aligned. And time frame it's actually technically it's a different dimension, but we're very, very good at measuring the direction and both the pattern and the direction on any time frame. And then it gets a little bit tricky, because you gotta collate that. You gotta know what direction and time frame is on all the different dimensions. But it's pretty easy to do. It's pretty simple to do. Once you have it, you have it. And we're going to show you how to identify direction on any time frame today. So yeah, it's possible, and Borat, it's all in the management of the trade. If you're in a counter trending environment, you got to exit the trades quicker. If you're in a trending environment, then you always exit that first or second contract maybe a little early, but you give it room for that second or third contract to run. So it is possible. It took us a while, and I see it as so simple now, but then again, it was a whole lot of sweat equity, a whole lot of time spent in front of the screen to come up with that. And really, to me, it's simple. I can explain it easily now. It seems simple to me, but there was probably somewhere between 15,000 and 20,000 hours spent coming up with that. And the biggest breakthrough was pattern. We had direction. We knew direction was pretty imperative, and we're going to show you that today, but it really was the pattern overall. And essentially, it's what we're going to show you today was knowing when direction is aligned with pattern. Philip J. So the edge of a method is generally in the exits rather than the entries. A lot of people say that. I was talking to a trader in Colorado. He's a mean reversion trader, and he was having a tough time because he was in such low volume markets, and he insisted on trading through August. And he said the same thing. He thought it was all in the exits. To me, it's still trade selection. It's still trade selection, because the market has to go far enough for you to get out of a portion of that position. And that's all about trade selection. So I don't agree. Well, you know, ifs and buts and candies and nuts, as the old saying goes. But no, to me, it's still trade selection. You have to be buying at the right. You have to be buying and selling at the right time. You have to be entering the market at the right time. For me, I think everyone's got it backwards where they say the exit is key. To me, it's all trade selection. So we'll go on, and hopefully you guys can learn something from this. As I said, the method I use is pretty easily explained, although it took a long time to come up with that. If I could summarize it in a sentence, we focus on markets with low non-systemic risk, i.e. currency markets, i.e. Stock indice markets, i.e. exchange-traded funds, where, you know, indices basically. Currencies or indices tend to have lower non-systemic risk. So we focus on markets with low non-systemic risk and look to trade at those times when the day-to-day news flow is aligned with the primary or secondary patterns. Now that's if I'm long-term trading. I think I amended that. Hopefully I did. Yeah, there we go. For me, when I'm trading, or when I'm in our master's course, for example, when I'm teaching in live markets, such as we were doing this morning, we're down on a 3-minute chart. We're taking a look at the 3-minute, the 15-minute, the 4-hour chart. Then we're going to focus on markets with low non-systemic risk, same thing, and look to trade at those times when the micro patterns are aligned with the day-to-day news flow, or we could take advantage of counter trend micro patterns also. So I could trend trade and I can counter trend trade at the same time. So focus on those times when the micro patterns are aligned with the day-to-day news flow. Day-to-day news flow is very important because, you know, your day-to-day pattern is a reflection of the day-to-day news flow. I happened to catch the tail end. I was coming in and out the tail end of the last guy that spoke, and he was where I was 10 years ago with the technical versus fundamental. There's the law of one in nature, and believe me, markets, like everything else on this earth and the heavens above, and you know the subatomic world below, even everything follows the laws of nature. There's one law. It's called the law of one. To me, in trading, the law of one means that technicals and the fundamentals are absolutely one. They're one and the same. What you see on the chart is absolutely a reflection of everything that we know that's going on fundamentally in a market. From my perspective, it can't be any other way. By the time the news gets to you, I like government releases because they're scheduled and they're timely, but it's still old news. Today's retail sales number is last month's retail sales, right? So the number you get in September is actually August's number. Likewise, by the time a journalist gets a hold of appropriate information and he writes it all out and he puts it in an article in such a way that it will get published, because they, you know, if we were to write articles about, you know, why the markets do what they really do based on what we see, they wouldn't get published. You have to be a clever writer. So my point being, by the time a journalist gets the information, he can assimilate it, write it out in a way that will get published. By the time it gets published, it's not always so timely anymore, is it? Markets move very fast. They discount information very quickly. So my point being that you know, fundamental information, technical information, it's one and the same. The market is one. So getting back to my point, that we look to focus on those micro patterns when they're aligned with the day-to-day news flow. And it's simple stuff, and I guess it's easier for me to demonstrate it for you than talk about it. So how can we help to improve your trade selection? Definitely we need to teach you when to know when direction is changed, because direction in the market will generally change before that news hits the wire, or right about that time the news is going to hit the wire. So any professional trader knows that price first. You're not going to, you have to have your stop in place. You have to follow your plan, and you know, regardless of what's going to hit the tape, that shouldn't have a marked effect on the management of your trade. It should be price. So how can we help you to improve your trade selection? You have to know when prices change direction, and really you need to know when it's in line with that all-important pattern. So how can we help you know when direction is aligned with price pattern? Again, it took us over 4 years to come up with this stuff, and the most important thing that I realized, and luckily I realized it ahead of the other guys, is that knowing when direction is aligned with price pattern was key, regardless of the time frame that you're on, regardless of the dimension you're on, be it a 3-minute chart, a 15-minute chart, 4-hour chart, daily chart. It's key to know when direction is changed, and particularly when it's aligned with the price pattern on the chart, because that's when you get the big moves. And of course, the price pattern on the chart is more not going to be, depending on the time frame you're looking at, it's going to be a reflection of the day-to-day news flow or even the primary trend. Your primary trend, of course, is a reflection of the business cycle at the time. And you don't want to argue with that, right? I mean, traders who argued that the trend in stocks was down throughout 2009 and 2010, what happened to them? Well, they're out of business. So you can't argue with direction, right? But you can't wait till bullish news hits the tape, because by then you've already retraced 50% of the whole thing. So knowing when direction is aligned with price pattern, that's actually the trigger we use. That is our trigger at Trading in Person. Now, before we go any further, we need to break this down and define direction. We need to know when direction is aligned with price pattern, so we need to define direction for you. If we're going to talk about direction, we're referring to change of direction, right? Because if I tell you the direction is up, then I need to be able to show you at what point that direction changed from down to up. So it's not direction, it's technically change of direction we're looking for. We define a change of direction, a COD, as being equal to a trend line break plus a directional line shift. Directional line shift, very important for us. That's what we also call a change of direction. And that's very important. That's our trigger. I don't get in a trade unless I have a change of direction. So if I'm going to teach you what we call a change of direction, I have to define that directional line for you. The directional line defined. If you have a chance, write this down. The directional line is, there's only one directional line per trend, by the way, per time frame, and it's going to be the low. The directional line is always the low of the highest closing candle in an uptrend. Imagine an uptrend. Now imagine the highest closing candle, that highest green close. Don't imagine the highest candle. It's got to be the highest closing candle. The closing price is very important. We're going to show you a great example of this in the Aussie on the daily too. So that highest closing candle, the low of that highest closing candle is a significant level, because if you close below it, if you think about it, when a market closes at its highest level, that's when it's the strongest. So when a market goes from being the strongest to then closing below the low of the candle when it was the strongest, there's something changed in the market, and that's why we call it a change of direction. Time and time again, that simple level proves to be very appropriate, proves to be pretty important, pretty relative. That's the word I'm thinking about. Likewise, the high of the lowest closing candle in the downtrend, very important to us also. Imagine a downtrend, imagine a series of red candles cascading lower. Now picture that lowest closing candle, and that lowest closing candle, the high of that lowest closing candle, very important for us. I want you to picture that. So you see that the lowest closing candle, the high of the lowest closing candle, a significant level. If you close above that, that's a significant development. So hopefully you guys wrote that down, the directional line defined. The directional line used, if price is closing below the directional line, the direction is down. Very simple. Price is below the directional line is down. If price is closing above the directional line, direction is up. So the directional line, very important to us. When you combine the directional line with the trend line, it's very powerful. And we'll get to that. Let me just give you a quick definition again to solidify this for you before we go to the chart. Thank you, Suge. Thank you very much. He says it's very important. You You must have experienced these things. Here's, again, a change of direction equals a reversal, price reversal, trend line shift, plus directional line shift. We all know what a trend line is. We all know how important they are, and believe me, they're important. You need this combination. Not only does price need to close below the trend line, it needs to close below the low of the highest closing candle. Here's here on top. We marked that white line. That's my directional line on the weekly. It's marking the low of the highest closing candle. So when you close below both the trend line and that directional line, that's an important occurrence. Likewise, down here, we get the same thing. That happens to be the high of the lowest closing candle. When you close above the trend line and the directional line, then we refer to that as a reversal. That's our trigger. At Trading University, that's our trigger for everything. I don't care what time frame you're trading on, whether it's a counter trend trade, a trend trade, that's always going to be the trigger. The trigger is always the same regardless of it. So the trigger is always the same. Whether you're in a trending or counter trending market, such as Borat's question, the only thing that changes for us is the trade management. So pretty important, that bit of information. If you want to know more about technique, I think I do a better job in my second book, Chapter 3 of Mastering Trade Selection and Management by McGraw-Hill. That goes a long way in demonstrating it for you. The easiest way, speaking of demonstration, is just go to the chart. Here's a chart of the Australian dollar on the daily chart. You can see that yellow line. That yellow line actually represents our directional line. The yellow line is our directional line on the daily. Let me go back in time here to when this guy topped out. This is fascinating. I think we were together in the beginning of the month when we saw this. All right, right here, that's the highest closing candle, right, at the time. Well, technically, this is the highest closing candle right there. Now, well, technically, the line's not going to shift until this candle's closed. The computer doesn't know this candle's closed until it gets the next candle opening. So the computer's actually delayed a little bit. But, I mean, this happens simultaneously. This candle closes, the next one opens simultaneously. So it's really not delayed. It just appears to be delayed. So this is the directional line because it's marking the low of the highest closing candle in the uptrend. You get a new high closing candle, boom, the line shifts up. Now guess what? You close below the line, and then the directional line is going to, now it's marking, it went from marking the low of the highest closing candle, now it's marking, it went from marking the low of the highest closing candle, now it's marking the high of the new low closing candle. This is fascinating at the beginning of the month. Look at how, and it could trade above it, it just can't close above it. So we knew right here that technically we had to change of direction, didn't we? We had to change of direction. However, we did not have the second half of that. We needed the trend line break. Remember, you need both the trend line break and a directional line shift. So you had the directional line, was telling you potentially prices topped out, but you didn't have the trend line break. Look at that. It was just walking that line. It couldn't trade above it. Well, let me back it up. Well, technically right there, but I like to see a red candle. So right there is when you had both the trend line break and the directional line shift. That told us that the market, that would be that's definitely a signal to clear out of longs at that point. Now, I'm a big believer in the higher time frame pattern, this longer term pattern. So, well, let me back it up again. At that point, I'm looking to sell rallies, though. I'm on the lower time frame because I have a change of direction. I have a reversal on the daily. I'm definitely more interested in selling rallies intraday at that point. Now I'm really interested in selling it. No, Alex, it works on all time frames. Now you have to get them both. You have to get the trend line break and the directional line shift. And now keep in mind, this is also it's only based on direction. When I say direction, I'm like, think short-term trend. It's going to work best. I'm not going to say it's only going to work. It's going to work best when it's in line with the pattern. And Bart said, do you ever have situations when price breaks the trend line, but it turns out to be a fit? Well, yeah, that'll happen all the time. You anticipate that happening. I love when a trend line gets broken because that tells me a counter trend move. When a trend line gets broken, then I'm in a counter trend move. If I'm in a counter trend move, I'm looking to get long back in line with the trend. So yeah, I love when a trend line breaks because that's when I go to work in working on pattern. We'll get to that. So pattern is the key. Direction is just a trigger. If you take every change of direction, sometimes you get lucky, make a lot of money. Other times you go slowly broke. It depends on the pattern though. So right now we could see here we finally see where that line is right here. You had to get below that low. Finally you're below that low, so you're going to get a directional line shift. At this point, I am all about selling rallies on the lower time frames. Because look, you got the long-term trend lines going, the direction is down, now you're all about trying to sell rallies. Just be patient, wait for rallies. Now, hopefully you're seeing those little orange and green, the orange and purple line there. That's a pattern line. The pattern is very important to us. It'd probably be easier for me to drop down to a 4-hour chart and show you. The purple line is the 50% retracement. The orange line is the 66% retracement. The Aussie loves the 66% retracement. I'll show you why. I'll show you how. Well, first let me show you, so you can visualize where those lines came from. Let's say we don't have the foresight to see what happened. We're taking that high, that low, and 66 and 50. So I marked the 50 and I marked the 66 because that's a zone. That's a sell zone for me. That's the area I'm interested in. Now, why did I chose 66? I happen to know the Aussie loves 66. Every market's got their own numbers, I think. But why did I know that? Well, when I go back here to the initial, this is still a higher high, right? But this is your first lower low, right? You broke the trend line. You had a higher high, really not significant. The trend's still up. But this is significant to me because that's a lower low, right? The lower low to that. So I'm taking that first move following the lower low, and I'm going to measure where the market topped out there. You guys could probably guess where it topped out. Boom, right at the 66, right between the 50 and the 66. Got a hair above the 66, but it tells me that zone is a potent zone for me. So the market itself told me that that zone was going to be significant for me. And then it gave it to me again here. Once again, markets top right between the 50 and the 66, or 618 by that time. 618 people were on it then, right? Well, where did the 618 people get stopped out at? Probably around 65. So that's why that zone was critical to me. That's why I had my pattern lines there. Once I see that zone hold and I see the market come down and make a lower low and it's just Katie bar the door, I'm all over every sell signal intraday. I'm all over it because it's already given me the pattern, right? All right, I'm going to show you some of these zones, how they came out. Where was that one? Yeah, all the way up there it started, but you come back. You come back this week. I happened to be on vacation, but I checked in and I saw it. There's the zone for you, right? There's a nice, you take that, move down, look where it tops right between that 55th, the 50 and the 66. That market loves those levels. I even saw one earlier this week. You take Sunday's high. And see that bad boy tops out right in there. Sunday's high. Tops right in that zone. So it's huge for us to know when you had that the shift on the daily, when you had the direction was down on the, not only it had broken the trend line, but the direction was down on the daily also. That's a big deal to know in there. So you're going to, you're really going to work on the sell side in there. So hopefully you guys get the hang of that directional line and you see it come down. I mean, from right there, that was it. Direction's down. Then it breaks the trend line. Now you're going to start selling rallies. You're all about selling rallies. And now you're going to get a little more aggressive with it too. So good, good example of that directional line working. Philip J., do you like patterns such as head and shoulders? I love traditional patterns on like the lower time frame charts. Even down to a 1 minute, 3 minute. I love those. I love traditional patterns in my zone. Once it's in the zone, I don't care what the pattern is, double top, triple top, head and shoulder, wedge. I love those patterns in the zone. Suj, when you know the confirm. The trigger itself is going to, well, whether I take the trade or not is going to depend on the pattern. The pattern shifted. Hopefully I'm making the point that right here everyone sees that once you take out that trend line, now the pattern's down. You go to a 4-hour chart at the time, and that happened to be right in here, the pattern's down. I'll categorize that pattern. Basically, 2 weeks on a 4-hour chart is going to give me my day-to-day pattern. So I knew that if this pattern held and I got a sell signal, then my day-to-day pattern was definitely down. So I have a really good idea for the next 2 weeks, these last 2 weeks, that the day-to-day was down. If the day-to-day is down, I'm going with it, because day-to-day is a reflection of day-to-day news flow. What happened to be the news flow? Well, everyone's talking about China stalling. So there you go. You may not catch that what the day-to-day news flow is exactly on the switch. Generally, the market will switch. The market will reverse before everyone knows about that news, but it will definitely be, the market's behavior is definitely reflective of that news flow. So hopefully you guys understand just that simple concept of tracking that first you're tracking the low, the highest closing candle on the way up. As long as it's up, and then it switched right there. As long as price is above that line, you're interested in the buy side. Once it shifts down, you're going to clear out of your longs, and you're going to wait for a trend line shift, and then boom, right there, you're going to focus on the short side. And I think, again, pattern, I'm big on pattern. Guess what? It happened to get up there, and you happen to have it was coming up on that trend line. Everyone knew it. August, I never trust the August move. I really don't. And in a way, I don't necessarily trust this down move, but I'm not going to argue. You don't argue with the market. Don't let, low volume keep you from making money on the lower time frames. But you have a pretty good idea that July and August, July you had a good rally, you had a low volume rally in July, getting a little toppy. You can see that overall pattern. So when you do get that change of direction, it should really come as no surprise for you. Alex, in this use of trend line, what's the rule of drawing it for the most distant swing point or recent point? I use just, all it takes is 2 points to draw a trend line. Really, 2 points. I mean, I was focusing on, this was my trend line because that's a 2-point trend line, and that's a legitimate trend line too. But I could see from, the momentum and everything else that, so just 2 points on the trend line. I just took the low to there. But generally 2 points will do it, and the third point will confirm. So hopefully you guys grasped what that simple tactic. Let me get back and define it some more. Again, Mastering Trade Selection Management Chapter 3, that's going to show you that line. But as I said, the way we're really going to help you is to help you identify when the direction is changed in line with the price pattern. Price pattern for us is the pattern created very simply by the market's highs and lows over time. It's just a matter of marking the isolated high points and low points on the chart, as we've done, and then, essentially visualizing or even drawing that rough channel that you get from them. And then once you've identified the pattern, and by the way, this chart, this is how many months ago, back in April, back in March, and even then you knew you had a bearish pattern, so we're interested in higher time frame change of direction on the higher time frame change of direction in line with that higher time frame pattern. And here's the bullish pattern. This is the U.S. stock market, and again, this is from back in April. And guess what? Yeah, you had a sell-off, but it proved to be a buy opportunity. Now the market made a higher high, didn't it? Yeah. Did you get to 1,500 yet? Not quite. I'm sorry. I was curious if you took out that high. Did you make a new high of the year here? Let me see. Oh, yeah, you just did make a new. It wasn't 1,500, my bad. 1,400. You just did take out a. You just did make a new high on this chart. 14 and a quarter. Came off and you went back up, but it was a bullish pattern to begin with. Something that's also very important for us. Whoop, let me set the camera here. Heim can't see. Let me reset the camera. Yes, Alex, always on a closing basis. Has to be on a closing basis. Okay, thanks, Tom. Also, another phenomenon of price pattern is it's absolutely markets themselves epitomize fractal geometry. I'm a huge believer that the markets are fractal in nature. I mean, it's just ingrained in me. I can see it all the time, where what happens on these higher time frames is replicated on the lower time frames. Likewise, what happens on the lower time frames tends to get replicated on the higher time frames too. And here's the thing, I love this. If you look back at 09, you get 1, 2, 09 to 2010, you had this 3 impulse moves up. See, 3 Elliott waves up. I'm not an Elliottician, but I'm a big pattern guy. I'm more Dow theory pattern. But what happened in 09, and that's what happened on the lower time frames, guess what? It happened to get replicated then on the higher time frames. Scalability is a two-way road. What happens on the lower time frames definitely can be replicated on the higher time frames. What happens on the higher time frames is definitely very influential on the lower time frames. So scalability is a beautiful thing. But what did I tell you? How am I going to help you improve your trade selection? No, when direction changes in line with the pattern. You have to know when the direction changes in line with the pattern. It's going to make your trading a lot easier. And the same thing happens on the lower time frames time and time again also. Oh, let me go. Scalability. It's important that you really understand scalability because it's easy to overlook basic patterns, especially if you're focusing on technical indicators or you're crowding your chart with other overlays. But if you know to recognize those higher time frame patterns, it becomes much easier to understand and then even expect those same patterns in smaller scale on the lower time frames. And what do you have here? I mean, there's a micro pattern. Here's a secondary pattern. And here's, well, keep it simple. Here's a short-term pattern. Here's the intermediate-term pattern. Here's the long-term pattern. What's happening in the short-term pattern is just mimicking that higher time frame pattern. And this is actually what we call Mandelbrot's generator. Mandelbrot, the father of fractal geometry. Fascinating guy. I actually have an article coming out next month in Technical Analysis, Stocks and Commodities magazine. Don't let the name of that magazine fool you. Technical Analysis of Stocks and Commodities magazine. There's more articles on Forex in that magazine than there are anything else now, because Forex is such a great market to trade because it has that low non-systemic risk. But I have an article coming out and it talks all about just this simple pattern, what Mandelbrot called the generator. The generator is a fractal itself. A fractal is something that a fractal is one pattern in a market that when replicated, it's essentially the base pattern in a market, the simplest basic pattern that when replicated creates the whole market overall. It's a very simple basic pattern that when replicated creates a much more complex design. And this, to me, this pattern is itself a fractal. Each pattern in there is a fractal, and all they're doing is replicating themselves. And it's pretty easy to see if you have a growth pattern because the pattern's going to be bullish. Now, the really good news here is not that markets typify fractal geometry, though of course they do. That's very good news. But the really good news for us is that as individuals, we're naturally very good at pattern recognition. We're very good at pattern recognition naturally, as long as we don't let the computer get in the way, as long as we don't let other indicators get in our way. In fact, one of the things that we're even better at than the computer is simple pattern recognition. If you go ahead and Google human pattern recognition, you'll get some cool articles that point that out, that the computer, I don't know if the computer will ever catch up with us as far as picking up simple patterns, because if the pattern varies just a little bit, which they do in markets, and fractal geometry too, if you get that variance, then that's going to throw you off. That throws the computer off. You and I see it pretty simply, but it throws the computer off. So, good news, fractal geometry works, and that we're naturally very good at it too. Scalability and repetition. Here's another great example of that. This is the Australian dollar back in March, and you can see the boom, 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 the simple scale to it. Guess what happened in March and May too? The market continued to go lower. So once you spot that negative growth curve, just stay on top of it. Yeah, that's it. Dantham got it. To me, it looks like a big higher high outside small. That's it exactly. That's fractal geometry. It's technical analysis. It's what the lower time frames are influenced by the higher time frames. If you have a negative growth curve on the higher time frame, it's more likely you're going to have a negative growth curve on the lower time frames. The key is the key is find a market that the lower time frames are opposite the higher time frames, and be really patient and wait for that to align with the higher time frames, and that's when you get good trades. So the key, the money show know when direction is aligned with that pattern. So every time you break a trend line, that's a change of direction, right? You're taking out the trend line, you're taking out the direction line, boom, you're getting nice trades along the way. Oh, sorry about that. So know when direction is shift in line with the pattern. Bam, bam. Very, very key to that. Yeah, that's right, Philip. Yeah, I apologize for that. So really, that's definitely the show. Let's take a look at the Euro chart now real quick before I talk away all our time, and we'll see what's going on there currently. And speaking of which, when I'm saying be very patient, this is what we look for. Move that up. You can see my primary pattern happens to be down. My secondary pattern is still down. Look, I draw those lines. It overran that line. What I need to do is update that line. Move that over. So you may or may not be coming up into such an area in the Euro now. I'm going to take that last impulse move down. And you can see that's where I marked that purple line happens to be the 50%. Generally, the Euro, it doesn't get much beyond that 50%. It's got a history of fizzling out just below it. So we'll have to see. But to me, the Euro is coming up in an interesting place. Not quite there yet. But if you can, ideally, if you can pop above that purple line for a little bit, really run the shorts out. You got a ton of hedge funds. John Paulson had a terrible year last year. Gold is going his way, but the Euro's not. So ideally, if you can blow out, Paulson, if you can blow out those shorts, you potentially get a nice setup here. Currently, direction is up in the Euro. You can see you're above the yellow line. My daily directional line, my yellow price is above the yellow line, and you're fighting that trend line. I don't even know how accurate that trend line may be. Probably this may be a more appropriate trend line. Yeah, that would probably be the trend line I'm going to focus on now. So this is an interesting setup in the Euro now. I love it when you get big rallies in the Euro because all it does is clear out all the shorts, and really all it does is set us up for another setup. And here's where it didn't quite get to 50%. So we really got to stay awake. Sometimes you're not going to get the perfect setup. There, see, it just got above you got that nice double top on the purple line. There it did reach the 50%. You're just below 50% now. Primary pattern's down, secondary pattern's down. So this will be very interesting. If we get I'd rather see it closer to the purple line here. But if we get, if it gets a hair above that purple line, puts in a double top on a 4-hour chart, I'll definitely be interested in seeing what happens as far as potential sell signal here. Yeah, I think it's close to it, Dathan. You never know. I tell you what, the secret in trading, have an open mind. The secret in trading, understand that markets absolutely follow the same laws of nature that govern us all. Likewise, have an open mind to that. If you have a closed mind in trading, you're going to get killed, right? There's a sign over Paul Tudor Jones' desk. It says, "The blade of grass that bends avoids the skiff." You have to bend as a trader, especially when you're just learning to trade for the first couple of years. You have to accept that you're going to be wrong. You have to have an open mind. Please understand that the same laws that govern us all, that govern, God's green earth, that same set of natural laws, the market abides by them too. Markets typify fractal geometry just as every other science is finding out. Biologists are finding out that everything's fractal in nature. Naturalists are finding out, of course, nature, we kind of already knew that. It followed fractal geometry. But markets, just like everything else, they're fractal in nature. So here's your euro. I think potentially, we'll have to keep an eye on this area of the chart. Pretty interesting for us. Here's the Aussie. Well, I'm not sure. If a euro turns around, it could be bearish for the Aussie. I guess you'd have to pull up for a weekly to get a good look here. There's a lot of room below there. Not sure about the Aussie. Look at the momentum's kicking down. Not quite sure about the Aussie. It looks to me, hey, keep it simple. That's a weekly chart. Looks like there's plenty of room on the downside. Same story in the euro. When I go to a weekly chart of the euro, I still think this market wants to test that 2010 low down at 119 or so. So that would be my target if it rolls over from there. U.S. stock market, very influential market also. Not sure there. I've been a bull for a long time on this market. I've been bulled up on the Aussie and the stock market for a long time. I'm not gonna back away from that bullish call in the stock market just yet because you just don't know. But I'm actually much more active on the lower time frames too. So even though I'm bulled up on it long term, you can see the primary pattern, secondary, they're all up. That won't stop me from making money on the short side if I had to on the lower time frames. So hey, thank you very much. We'll be back tomorrow for more talks on fractal geometry. If you want to learn more about what we're doing, check us out at trading-u.com. We hope this demonstration helped you. Whoop, let me switch. There we go. We hope the demonstration helped you. If you'd like to learn more about our course, go to our website at trading-u.com. Okay, thanks everybody. Thanks, Maud. Yeah, and we're all, it's recorded, so if you want to go back and review, that'd be great. Thank you, Philip. I'll see you guys tomorrow.